The market is currently closed for the weekend. The latest official trading session for NVIDIA ended on Friday, June 12, 2026 at 4 p.m. Eastern Time, with the stock closing at $205.19 per share, marking a minor intraday gain of 0.16% after experiencing significant volatility throughout the week. While the headlines focus heavily on this micro-stabilization after a steep drop from its mid-May all-time high of $235.47, the real story brewing under the surface isn't about short-term stock price fluctuation. The core surprise that institutional traders are watching right now is a fundamental shift in hardware architecture dominance. Many retail buyers using a popular online trading platform or scanning basic investing sites assume the company's near monopoly on data center graphic chips is unshakable. However, the unexpected reality is that the next phase of tech infrastructure relies heavily on unified platforms that bind specialized central processing units with custom logic, an area where alternative architectures are trying to claw back market share. This sets up a profound disconnect between the narrative of indefinite, easy growth and the reality of complex engineering battles currently being fought in global data centers. The general belief among the public is that the enterprise is an untouchable fortress, destined to expand its valuation effortlessly toward the $5 trillion mark. Investors logging into their individual brokerage accounts or checking their positions via the Robinhood app see a dominant player that single-handedly dictates the pace of silicon development. The contrarian take, however, points to structural shifts in capital expenditure budgets. Cloud service providers are increasingly testing internal chip designs to reduce reliance on single-source suppliers. This creates a critical tension between expectation and reality. The market expects margins to remain permanently elevated, while the reality of corporate procurement dictates that enterprise buyers will always seek to diversify their supply chains to break pricing bottlenecks. When you study the trading desks at major institutions like Fidelity, the heavy volume reveals that large asset managers are quietly reassessing how long this pricing power can last, shifting focus towards software integration and system-level connectivity, rather than just looking at the sheer volume of silicon shipped. When analyzing recent stock movement, the intense daily swings showcase how sensitive the equity has become to macroscopic liquidity shifts. Over the past month, trading volumes have surged well above their trailing 3-month averages, signaling that big institutional blocks are changing hands. This volume spikes whenever economic indicators hint at shifting monetary policies. Because tech infrastructure requires massive upfront investments, high borrowing costs act as a hidden drag on tech valuation trends globally. In recent sessions, when options expiration cycles hit the market, the equity faced intense downward pressure, breaking through intermediate support levels before establishing a temporary floor near the $200 threshold. For anyone utilizing a sophisticated interactive brokers platform, the data tracking institutional order flow reveals that automated market makers have been hedging aggressively against downside tail risk. This indicates that while retail optimism remains buoyant on mainstream social forums, professional risk managers are structuring defensive positions to protect portfolios against a broader market contraction. The broader sector momentum has also entered a consolidation phase, which directly impacts the immediate trajectory of the stock. For months, hardware manufacturing outpaced broader market benchmarks, lifting indices to record heights. Now we are observing a rotation, where capital is migrating slightly toward enterprise software providers and consumer platforms that utilize hardware rather than build it. This rotation explains why, despite robust corporate updates and new open foundation model announcements like Cosmos 3 for physical robotics, the stock price has struggled to regain its absolute peak. The market is demanding evidence that these advanced software systems can generate direct, high-margin subscription revenues rather than just serving as a marketing tool to sell more physical server racks. If you look at the premium tools on a Fidelity trading platform, the technical indicators suggest that the stock is currently caught in a classic distribution phase, where long-term holders are gradually taking chips off the table while late-stage momentum buyers absorb the supply. To properly evaluate where the business stands, it helps to ground our understanding in what the company actually does and how its underlying business model operates. Historically, the firm built its reputation by creating high-performance graphics processing units that catered primarily to PC gaming enthusiasts and visual design professionals. Over time, management recognized that the parallel processing capabilities of these units were perfectly suited for complex mathematical calculations, particularly deep learning and heavy data analytics. The business model evolved from selling standalone components to delivering fully integrated computing stacks, comprising specialized silicon, proprietary networking architecture, and an extensive library of software development kits known as CUDA. This software layer is arguably the company's strongest moat, as it locks developers into a specific ecosystem, making it incredibly costly and time-consuming for enterprises to switch to competing hardware platforms. Looking back at past performance and older financial reports, the trajectory is a textbook study in aggressive scaling. A decade ago, the organization was a mid-cap player operating in a highly cyclical industry. The explosive demand for high-performance computing centers completely altered its financial profile, leading to multi-year stretches of triple-digit revenue growth and operating margins that traditionally belonged to pure-play software enterprises rather than hardware manufacturers. However, this historical success creates a high baseline for comparison. Today, the corporation holds an immense market capitalization of nearly $5 trillion. Maintaining a high growth rate at this scale is an entirely different challenge than scaling from a smaller base. The sheer volume of raw materials, logistics, and power infrastructure required to sustain this trajectory presents execution risks that historical data simply cannot fully predict. Comment below how many shares of NVIDIA stock you currently hold, or if you are choosing to allocate your capital elsewhere in the tech sector right now.
Looking ahead, the future outlook will be dictated by several critical catalysts and structural risks. One of the most significant opportunities is the expansion of physical autonomous systems, where unified models process vision, sound, and action to operate machinery and vehicles in real-world environments. Furthermore, recent strategic efforts to pitch specialized processors to overseas regional markets suggest that the enterprise is actively working to reopen international sales channels that were previously restricted by trade policies. If successful, these markets could provide a meaningful secondary growth engine that Wall Street analysts have not yet fully baked into their consensus models. This potential upside keeps momentum alive across major trading environments, whether an investor is managing their own wealth through self-investing or utilizing an automated SoFi robo-advisor setup to capture sector exposure. On the risk side of the ledger, competitive pressures are mounting from multiple angles. Major cloud hyperscalers are investing billions into developing custom application-specific integrated circuits tailored exactly to their internal workloads. While these internal designs may not match the raw versatility of a premium global graphics processor, they are often sufficient for specific tasks, offering a significantly lower total cost of ownership. Additionally, macroeconomic pressures like persistent inflation or logistical bottlenecks in global foundries could compress operating margins quicker than the broader market expects. If corporate capital expenditure budgets tighten even slightly, the expectation of uninterrupted growth will instantly collide with the reality of a cyclical hardware market. This tension ensures that the stock will remain a primary battleground for bulls and bears alike, requiring investors to look past superficial hype and focus deeply on concrete shipment data, contract renewals, and platform retention metrics. In summary, the narrative surrounding this technology powerhouse reveals a stark contrast between market perception and structural reality. The common expectation is that the company's dominant position guarantees a frictionless path upward, insulated from the traditional laws of market cycles. The reality, as evidenced by recent volatile trading volumes and active institutional hedging, suggests that the enterprise is entering a mature phase where execution risks, supply chain diversification, and architectural competition will test its premium valuation. While software ecosystems and breakthroughs in robotics provide valid pillars for long-term optimism, the near-term path requires navigating shifting capital rotation and enterprise budget discipline. Understanding this underlying friction between aggressive growth expectations and complex operational realities is what ultimately separates sustainable portfolio management from speculative trend following across modern investment markets. Disclaimer. This video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Backter. Don't forget to like, comment, and share this video to support the channel.